DCF, discounted cash flow analysis, is a commonly used method for evaluating the intrinsic value of a company. It is based on the idea that the value of a company is determined by the present value of its expected future cash flows. Here are the steps to evaluate Amazon using DCF. Step 1. Estimate Amazon's free cash flow, FCF. FCF is the cash generated by a company after accounting for all capital expenditures needed to maintain or grow the business. To calculate Amazon's FCF, we can start with its operating cash flow and subtract its capital expenditures. Operating cash flow for the last 12 months, as of September 2021, was $92.5 billion, and capital expenditures were $24.5 billion. Therefore, Amazon's FCF is FCF equals operating cash flow, capital expenditures. FCF equals $92.5 billion, $24.5 billion. FCF equals $68 billion. Step 2. Estimate Amazon's growth rate. Next, we need to estimate the rate at which Amazon's FCF is likely to grow in the future. One way to do this is to look at the historical growth rates and make an educated guess about future growth. Amazon's FCF has grown at an average rate of 25% over the past 5 years. Assuming a conservative growth rate of 15% for the next 5 years, and then a terminal growth rate of 3% after that, we can estimate Amazon's future FCF as follows. Year 1 FCF equals $68 billion x, 1 plus 15%, equals $78.2 billion. Year 2 FCF equals $78.2 billion x, 1 plus 15%, equals $89.9 billion. Year 3 FCF equals $89.9 billion x, 1 plus 15%, equals $103.4 billion. Year 4 FCF equals $103.4 billion x, 1 plus 15%, equals $119 billion. Year 5 FCF equals $119 billion x, 1 plus 15%, equals $137 billion. Terminal FCF equals $137 billion x, 1 plus 3%, 11% 3%, equals $1,760.94 billion, 11% is the WACC. Step 3. Determine Amazon's discount rate. The discount rate is the rate of return required by investors to compensate for the risk of investing in a company. A higher discount rate indicates a higher level of risk. To determine Amazon's discount rate, we can use the CAPM, Capital Asset Pricing Model, which takes into account the risk-free rate, market risk premium, and Amazon's beta. Assuming a risk-free rate of 2%, a market risk premium of 6%, and Amazon's beta of 1.5, we can calculate Amazon's discount rate as follows. Discount rate equals risk-free rate plus beta x market risk premium. Discount rate equals 2% plus 1.5 x 6%. Discount rate equals 11%. Step 4. Calculate Amazon's intrinsic value. Finally, we can calculate Amazon's intrinsic value using the discounted cash flow formula, which is the sum of the present value of all future cash flows. Intrinsic value equals year 1 FCF 1 plus discount rate caret 1 plus year 2 FCF 1 plus discount rate squared plus terminal FCF 1 plus discount rate caret 5. Intrinsic value equals to $78.2 billion per 1 plus 11% caret 1 plus $89.9 billion per 1 plus 11% caret 2 plus $103.4 billion per 1 plus 11% caret 3 plus $119 billion per 1 plus 11% caret 4 plus $137 billion per 1 plus 11% caret 5 plus $1.76 trillion per 1 plus 11% caret 5. Intrinsic value equals $1,423 billion. We made the assumption that Amazon's cost of equity is roughly equivalent to its WACC for the purpose of simplifying the calculation. However, according to GuruFocus.com, as of the end of March 2023, Amazon's WACC is 9.65%. Step 5. Compare intrinsic value with market value. The last step is to compare the intrinsic value we calculated with the current market value of Amazon. As of March 2023, Amazon's market capitalization is around $2.4 trillion. Comparing the intrinsic value of $1,423 billion with the market capitalization of $2.4 trillion, we can see that the market value is higher than the intrinsic value, which suggests that the stock may be overvalued. However, it's important to keep in mind that the DCF analysis is based on various assumptions and estimates, and the actual value of a company may differ from the calculated intrinsic value. Therefore, it's important to use multiple valuation methods and take into account other factors such as industry trends, competitive landscape, and management quality to make an informed investment decision. To calculate the estimated per-share stock price based on the DCF analysis, we can divide the intrinsic value by the total number of shares outstanding. As of December 2021, Amazon had around 500 million shares outstanding. Estimated per-share stock price equals intrinsic value, shares outstanding. Estimated per-share stock price equals $1,423 billion per 500 million. Estimated per-share stock price equals $2,847. Therefore, based on this DCF analysis, the estimated per-share stock price for Amazon is $2,847. However, it's important to note that this is just an estimate based on certain assumptions and estimates, and the actual stock price may differ based on various factors such as market sentiment, company performance, and global economic conditions.